going to continue to grow their revenue base, have a lot more potential for stock appreciation. Hovnanian is probably by far the most potential for.
Hello, everyone, and welcome to another episode of The Pragmatic Investor. My guest today is Kevin Erdmann, a fellow substack writer and the author of two very interesting books on real estate. I recently stumbled onto Kevin's substack and was captivated by his unique take on the real estate market and the housing sector. Housing is an incredibly important sector when it comes to the economy. In terms of macroeconomics, it can tell us a great deal about business cycles. Since the 2008 financial crisis, it seems like everyone is expecting a housing bust every other year. However, Kevin has a very different, refreshing and unique perspective on the housing market. The way he sees it, there's a secular undersupply in the housing market, which will lead to a secular bullish market. Kevin actually has quite a positive outlook for the coming years. Kevin also has a pretty unique perspective on monetary policy and the Federal Reserve, so we also spent some time talking about this. In today's conversation, we covered everything to do with real estate, the housing market, and also monetary policy and the Federal Reserve. To wrap up, Kevin gave us some pretty actionable investment ideas as to how investors can profit from housing and real estate. I really enjoyed this conversation with Kevin. He's incredibly knowledgeable when it comes to the housing market, and he has a pretty unique perspective. If you haven't already, go ahead and check out Kevin's Substack. A link will be provided on the description, and also go and check out his books on real estate. As always, I hope you enjoyed this conversation as much as I did. Welcome to the show, Kevin Erdmann. Thank you for coming.
Yeah, thanks for having me.
All right, for anyone who isn't familiar with your work, just let everyone know what you're doing, what your background is, and just introduce yourself to everyone.
I Substack at the Erdmann Housing Tracker, which is kevinerdmann.substack.com. In my background, I was just a small businessman, and it's been about 8 years ago now. I just blogged on the side about sort of anything I was thinking about, but frequently about investing, and intended to spend a couple weeks studying the housing market for housing investment in the housing area, and just accidentally sort of discovered that all the conventional wisdom about the financial crisis was wrong. The credit data, for instance, you don't really see like a decline in the average income of homeowners during that boom period. You don't see a decline in the average credit score of new mortgages, that sort of thing. All these things that seem to be conventional wisdom was that we had these generational defining changes in standards. Just don't show up in the data really at all. Frequently they go the opposite direction. And so a brief study to see whether I should invest in a home builder sort of turned into months and years. At the old blog, I ended up with, I think, 350 or something posts about housing. And eventually it was probably 6 months into it before I really realized all these mysteries, all these disconnections were basically explained by a supply problem. So the reason I'm here, the reason I'm still out here talking about this and talking to you today is really the nub of my sort of insight is that even in 2005, we had really a shortage of housing in the United States is what was driving everything that was happening. And since conventional wisdom, including up to policymakers and Federal Reserve officials, was that we had this oversupply of housing that led to necessary collapse in housing starts and all that sort of stuff. Since that was conventional wisdom, it was important that we had actually had a shortage. And so I've really just spent the last 8 years becoming an accidental housing market expert and just following my nose down that path. Eventually, I was a visiting fellow at the Mercatus Center and put out a couple books and several papers while I was there, and I've sort of meandered to this Substack in the meantime. And so the two books are called Shut Out, which is really a book about the core problem and all the ways that the lack of housing affects the American economy. And then the book Building from the Ground Up is more of a timeline of the boom and bust in the 2000s, and how you would reimagine the things that were happening, the policy decisions that were made from this new point of view of this upside down idea of what was happening in the housing market. And then here I am today.
Absolutely. Very, very interesting, very nice origin story. I like how you just kind of fell into that rabbit hole of the housing market. I feel like that's often how you get the start in a lot of ways. That's kind of how I started with economics. Just you end up stumbling on a blog or something and just can't stop reading and fall into that rabbit hole. But you mentioned some of your previous books, and that's actually where I wanted to start, because I haven't had a chance to read the book yet, but I did go through the summary of Building from the Ground Up, Reclaiming the American Housing Boom, which is your most recent book, right, which came out in 2022, I believe.
Yeah.
And yeah, I think it's very interesting. You basically kind of, like you've said, you have a kind of a contrarian view, let's say, kind of defying a lot of the conventional wisdom. So I wanted to go through a couple of the points, maybe just to get your point of view, and if you could develop a little bit on some of these points. For example, you say, for example, that there is little reason to blame the housing boom on loose monetary policy or excessive stimulus, which of course goes against what a lot of people would think. So what exactly does that mean? Could you elaborate a little bit?
Yeah, I mean, I think you probably a starting point there is with the monetary school of thought, which is the market monetarists, which Scott Sumner. I've done a bit of work at Mercatus with Scott Sumner, who's one of the big proponents of that, and I think that's really sort of what opened the door to me to view housing a different way. Was that the market monetarist point of view is that nominal GDP growth is really the most accurate way to describe the stance of monetary policy. Inflation can be affected by supply conditions, which obviously we've seen like never before with the COVID interruption, and interest rates are very confused. I think one of the great sort of inflictions on the American investor is the way that the Federal Reserve gives the impression that they control interest rates, and that through that control they manipulate the economy. I think it was Milton Friedman who Sumner frequently will cite, that said, low interest rates today are generally a sign of yesterday's tight monetary policy. And effectively, I think that's where we were in the 2000s. Inflation was never particularly high. Nominal GDP growth. Scott Sumner has sort of lowered his estimate of our sort of run rate neutral nominal GDP growth over time. I still think about a 5% nominal growth rate is reasonable and should be considered basically neutral. In 2004 and 5, we might have hit 6% and change. And by 2006 and 7, we were down into the fours, 4 plus something. And that's a bit above even my target, but it's lower than any expansion since World War II had been. So there's really no reason to, except for low interest rates, to claim that the Federal Reserve is particularly loose. And then also coming out of my work, where I'm pointing to this shortage in housing. Actually, if you disaggregate the CPI and pull rent inflation out of it, which I've been doing for years, a lot of people have been choosing and picking CPIs through the COVID period. I've always deferred to a non-shelter CPI target because most of the shelter component is rent, and most of the rental value that they're measuring is the estimated rental value of owned homes. And the little old lady in suburban San Francisco that paid off her home in 1996 just doesn't even know that the rental value on her home, it is a true measure of cost of living, that the rental value of her home is going up 5 or 6% a year. She doesn't know that. It certainly doesn't affect her spending, and it should have nothing to do with how we conceive of cyclical monetary policy decisions. So I prefer to just take shelter out of it, and look at, and if you do that, really since 1990, the mid 90s, even going back further to a certain extent, but certainly by since the mid 90s, the rent component, the shelter component, has averaged something like 1% plus excess every year. So that if you take it out, even based on the Fed's 2% inflation target, we've been perennially below that target for all of these 30 odd years. There's just no reason to claim the Fed has really ever been loose. We can argue about some of the a few months here during the COVID thing, up or down, but certainly from the mid 90s to COVID, there's really not a single quarter where you could claim that they were loose at all, let alone loose to an extent that you create this generation defining bubble.
It's very interesting, and like I said, obviously it's something that a lot of people would feel surprised to hear, right? That the Fed has actually been too loose, when the common narrative is that they've been just way too tight and all these things. Now, so you also say that, and I'm reading here from the summary, the Federal Reserve guided the market to a soft landing by 2007. 2008 should have been a year of recovery, but by the time the soft landing came, the Fed became convinced of the myth of housing oversupplied and ignored stark evidence of a coming crisis. So I kind of wanted to develop a little bit more then. If then, let's say that the Fed wasn't exactly to blame for this crisis, what exactly happened with the housing crisis? What happened in 2007, 2008 to lead to that collapse, let's say?
I mean, I would say to a certain extent, I blame them less than I used to, but to a certain extent, they are to blame for the crisis. But the normal pattern of blame is that they made all their mistakes in 2005, and that by 2008 there was nothing we could do but let that unwind. We'd had a bubble until eventually it had to bust, and so it sort of let them off the hook. The worse any policy decision went is in 2007, 8, and 9, the more people liked it, because the bigger the crisis, the more people the more it confirmed for everyone that, see, we knew we'd overdone it in 2005, and we had this coming all along. And so really, to me, that's the crux of the crisis, is that crisis really became the popular stance, even if nobody would put it that way. Explicitly, you can see that reaction if I suggest that lending standards shouldn't have been tightened, or the Fed should have lowered interest rates sooner. You commonly get almost an angry reaction of, you'd take us back to that time, the Wild West of 2005. Sure, So people really did sort of demand this that outcome. And you can see one of the key moments that I go into in my work is the every year at the end of August, the Fed goes to Jackson Hole for this annual sort of conference outing. And that year they had John Taylor, who's famous for the Taylor Rule and is always a frequent critic of saying that they're too loose and blaming him for the housing bubble. And Ed Leamer, who's a economist from UCLA, who both addressed housing. Taylor with the conventional sort of, you were too low for too long and it led to 1 million too many houses. And of course, by the time he gave that speech, actual housing starts had already declined more than enough to make up for any of that. But everyone was so wedded to the story that nobody was about to change their tune. And then Ed Leamer, who actually has a great, it's a commonly cited paper, is called "Housing is the Business Cycle," and he has this. It's a very useful concept. It actually is the sort of thing the Fed should use to guide it. Which he basically said the housing market is a leading indicator for the business cycle, but it's important in terms of production. It's important in terms of employment, and so you're looking at housing starts and home sales, and when that's declining, you better watch out. A recession's coming, and as you hit a recession, that's going to be the first thing that recovers. And don't worry about prices. Prices don't really ever go down that much, and if they do, it sort of lags. But unfortunately, even though he came with the exact story they needed to hear, he was caught up in this wave of conventional wisdom, and he couldn't imagine that at the moment he was speaking, we'd gone from having a shortage of housing to having a very moderate little building boom, but back into having a shortage. And he just couldn't imagine that expanding that a recovery in housing starts could possibly be part of the reaction function that the Fed would be working on. So he effectively disowns his own system by sort of just weekly claiming that there were so many houses that this time was different than all the previous times, and housing starts had to go down for another couple years before they could recover. And so that's the blueprint the Fed is following as we're going into 2008 and 9. They should have really been looking to stimulate the economy. They should have been looking for a recovery in housing starts. And as I outlined in Building from the Ground Up, meeting to meeting to meeting, you see them at first they didn't forecast a big decline in housing starts. They would just lower their forecasts each meeting they would say, okay, here's where the new bottom is, and then the next meeting go, okay, the bottom's a little lower, but now it's the bottom. And you can see them slowly lose their grip on what the 2005 Fed would have said, which would have been to get housing starts to recover once they were that deeply, by late 2007, they were down 50+%. And you can see them slowly as the meeting after meeting, the housing starts and new home sales don't meet their forecasts. They start believing the critics, believing that really we'd had too many houses to begin with. So the steeper housing starts decline, the more their forecast starts leading the decline. And they start say by the end of 2007, they say, oh, by the end of 2008, starts are going to be much lower than they are now. And then they'll recover. So the Fed really became pro-cyclical. And all of that was could have been, I think, reversible. I think, they've been too tight going into recessions a dozen times since World War II. That wouldn't lead to a crisis in itself. I've increasingly come to the conclusion that what really sort of kicked crisis into gear was lending standards tightening, mostly through control of the FHA and Freddie Mac and Fannie Mae, loosely over the course of the early 2008, eventually directly through the conservatorship when the government took them over in August of 2008. There's just a sharp multi-sigma tightening of lending, unprecedented tightening of lending over the course of that year. And so partly what led to my Substack and the model I use of the Substack is that I was able to, one of the models I used to look at home prices across the country was that I was able to actually see the shadow of that tightening. I could see the effect that had on home prices in credit constrained neighborhoods across the country, cities that had bubbles, cities that didn't have bubbles, cities that'll never have bubbles, every kind of city, Texas cities, California cities, the low end dropped measurably by double-digit percentages over the course of 2008 and 2009 as that credit tightening hits. it's the untold story of the crisis that really we imposed a wealth shock that was highly regressive
Mm-hmm.
through repressive credit policies that are still in place. Um, and you can it's such, it's funny because there's 1,000 papers that are, you know uh, doing a bunch of
Mm-hmm.
statistical regressions to find that, we found that, some banking rule made a 3% difference in home prices and stuff. That's what caused the bubble. This is at my model of Substack. I attribute 20% of the drop of the average home to these
Mm-hmm.
tightened lending standards. That's the average home. The high end home that doesn't need credit or still gets credit had no effect. The bottom end, you're talking 40% drop. And
Mm-hmm.
it's just clear as day throughout the country that tightening of credit was really part of our communal insistence on crisis and wealth destruction.
Mm-hmm.
That really is the crisis. It's by far the most popular part of the crisis. That
Mm-hmm.
you in most audiences, I would be laughed out of the room for suggesting that we go back to 2005 lending standards in any way at all.
Mm-hmm.
But you can see it sucked $5 trillion out of working class American balance sheets.
Mm-hmm. It's very interesting, that kind of idea, I guess, of that self-fulfilling prophecy, right? Everyone wants that crisis, and eventually they get it. Now, I want to take this now into the present to 2023, because of course, a lot has happened with housing. Of course, we had COVID, all that stimulus, house prices shot up, and everyone's kind of since then, I guess, fear sells, and it's always going to be the next housing crisis, and people were expecting that with such high interest rates that home prices would really come down. It hasn't really happened, and obviously there's a lot of reasons for this. Like, I know inventories have been mentioned, so just wanted to know what is kind of your take on what's happening with housing right now.
Mm-hmm. Yeah. So one of the sort of foundational ways that I came to it empirically, but sort of then it fits into my model about how all this is working, is that I really
Mm-hmm.
just attribute, and again, you can to the extent that we have rent data available, you can see it working out in the data. Really,
Mm-hmm.
everything about housing is coming through rental value. That rental values have been going up for the better part of at least 30 years. Uh, and since the really from World War II to the mid 70s, we were truly in a building boom sort of era,
Mm-hmm.
and that was keeping rents down, that was keeping home prices moderate. And so up through the mid 70s, something like 9% or maybe 8% of GDP went to rental value, including the rental
Mm-hmm.
value of owned homes. But sort of taking the entire stock of homes, what would they rent for if we were writing ourselves checks each month?
Right.
Something like 8% of the of G. I always should look this up before I sit down for interviews, but I think it was 8%.
Mm-hmm.
And then you can see the residential, whether you're looking at housing starts per capita or residential investment as a percent of GDP, whatever measure you want to look at, starting in the early 80s, that all starts to fall. In the 70s, you can see just manufactured home shipments drop off a cliff because of basically regulatory capture of the home, the stiff built home builders that basically got it regulated out of existence. Apartment units, we were building them, you know, 4 or 5 units per thousand residents in the 70s, and then it drops to just nothing after that. We're for the last decade, or for the last few years, we've basically been sort of hitting that sort of national cap of how many apartments. It's very much a regulatory limit on how many apartments we can build, and we've just sort of been bumping up against that for years now. And so we're in the midst of, basically over the course of the 20th century, we sort of put all these local land use regulations in place that just make it too hard to build housing, especially multi-unit. And so over the last 50 years, rents have been slowly going up. But our real consumption of housing The actual like size and value of the houses we live in has actually been growing at a slower pace than our incomes and our other spending has been for in real terms for 50 years. Rents have been going up due to rent inflation. So now we're up to something like 12% of GDP goes to rent. And if you compare today to the 70s, that again, that's not because we are living in houses that are 50% larger compared to our incomes. Up until the 2000s, the houses were sort of getting bigger and nicer, but just at a slower pace than income. Since then, real housing consumption's flatlined since the Great Recession. But cumulative rent inflation is something like 60% over that period. So rents explain everything that's happening, including the 2000s boom. Sorry, my my answer is getting probably much longer than you wanted, but
please go on.
But partly what happens is when you have a secular problem where something is just getting more expensive year after year after year after year, and there's this, this is an extreme process. We're talking 60% cumulative inflation on rents compared to other goods and services. This is an extreme problem. Right. But what happens is housing is a cyclical market. And so as we're climbing that 60% hill, we're doing this as we're climbing it. So what happens is every time we're at a cyclical peak, everyone says, it's the cycles that's the problem. Look, housing is more expensive than ever before. It's this cycle that we're in. Let's kill the cycle and we'll solve the problem. And you just keep falling to ever higher cyclical lows because you're on this escalator to ever higher rents. And so again, as you mentioned, now we're back up to the top of the cycle, and everyone, here we are. We're even a bigger cycle than we had before. We have to stop the cycle, but it's all just because the cycles are on an escalator. So anyway, one of my sort of fundamental sort of ways to think about this is that rents rise at more than a 1-to-1 ratio or prices rise at more than a 1-to-1 ratio with rents, basically in all contexts. If you compare the low end of a city to the high end, the price to rent ratios will be higher where the rents are higher in that city. If you compare Dallas to LA, price to rent ratios are higher in LA. If you compare 1975 US to 2023 US, price to rent ratios are higher today than they were then because the rents are higher. Because of rent inflation, because those higher rents are land rents, they're just monopoly value. And so there's no depreciation with that extra rent. There's no, it's free money. So it gets bid up to a higher value. And so if you just model the American housing market to rising rents with say a 1.5 ratio of price to rents as those rents are rising up, you can very easily explain everything that's happening in home values with rising rents. And that's effectively what's happened. I have some Substack posts where I show, you can model it. Zillow has rents down to the zip code level, back to 2015. And you can, from 2015 to 2019, rents were rising at real rents basically were rising at like 2% plus more than regular generalized inflation. And so prices were rising, at 150% of that clip. And it all just rises right together for 4 years leading up to COVID. Then general inflation spiked during COVID. And if you use Zillow for rents spiked during that period at exactly the same pace, plus a little more than 2%. And prices rose along with it at CPI, general inflation, plus 2% times 1.5. It all just moves very closely together. There's very small amount of the deviation between prices and rents that you could attribute to, say, low interest rates in 2021, early 2022. So yeah, it's all a supply now. So we have this general inflation spike that was temporary, that happened and it was over. It's not going to reverse because the Fed has done an excellent job this time around. But everything in the housing market is just 90% of what's happening in home values can be explained by that rent spike. A combination of that rent spike and the very systematic behavior that happens in housing markets that starts with rent being higher than general inflation every year, year after year after year.
Right. So if I'm understanding correctly, kind of part of your underlying thesis is that there's basically kind of a secular shortage in housing, right? And that can be partly attributed maybe to regulatory constraints that we put on house building, for example.
Yeah. So everyone agrees that homes are too expensive and that inevitably there needs to be a reversal. And I would agree with that. It's just not going to, we don't have any, we knocked millions of people out of the credit market in 2008 and we didn't let them back in. So, I say you can only cut your leg off once. So we can't do that again. So we can't cyclically cut 20% off the value of American housing because those people are already can't get mortgages. And so there is really no cyclical way to lower prices. The only way to make housing costs reasonable again is building. So, and you can't build enough new housing in a single year to reverse 60% rent inflation of the half of a century. This is going to be a long, drawn out process. So that's why I'm very bullish on the home builders, because they're sort of in a no-lose situation. Either prices are going to continue to rise unusually because rents are going to keep moving above general inflation, or they're going to be very busy building millions and millions of homes that are desperately needed that slowly will bring down rents so that maybe 20 years from now we can look back and say, hey, we've gotten housing costs under control.
Right. Of course, that's a very compelling long-term bullish thesis, of course, on housing. Like you say, the home builders. Zooming in though, like right now, as we said before, during there's that cyclicality. Are we near that top potentially? Because we've definitely over the last couple of days we've got some housing data that you could argue is weak. I recently saw David Rosenberg on Twitter posting the fact that new single-family median sale prices have fallen by 18% year on year in October.
Yeah, actually, we're in a very interesting situation with housing, with new home prices and housing. Partly what happened is that part of that spike in rent inflation and general inflation was, these supply chain related, COVID related supply chain issues, and really. From late 2020 till late 2021, there was a bit of a spike in demand, but effectively what happened is that the home builders were sort of capped at capacity by these sort of I've never quite put my finger on what still needs to be healed, but they're just always like windows are 6 months behind or whatever. They're just always waiting on some portion of the supply chain to get a house to completion. And so really what happened, it really was a unique situation in the history of American home building markets in that there was this bit of a moderate rise in demand. So basically all of the finished inventory got bought up. Then all the inventory under construction got bought up, and then the demand sort of went to queuing. So for 80 years, it's taken about 7 months to build a single family home. Occasionally that spikes upward because like in 2007 and 8, there was this demand crash and they were actually just stuck with houses they couldn't get rid of. In this case, we actually had average construction times spike because they just couldn't get the windows in to finish the project. So So what happens is now people start buying a spot in the queue, right? So now it's taken 8, 9, it eventually gets up to 10 months to build a house that for decades has taken 7 months plus or minus a couple weeks without fail, except for the occasional demand shock. And so basically for a while there, what you had was this deal where people wanted to make sure they had a place in the queue. And so they were willing to pay more for it. And the home builders are basically making this negotiation between the suppliers and the clients. We're going to overcharge the client by 15% and put them in the queue. And, if we have to pay 5 or 10% more for supplies to get ourselves higher in the queue, to get that house to them faster, get it out of our inventory, we'll pay a little extra. So everything gets elevated during that time. This has never happened, as far as I can tell, ever in the history of the American housing market, to have a national supply crunch like this. So the new home builders had this weird period where people are paying a premium to be stuck in line.
Right.
And so, about the time that, probably rising mortgage rates had a little bit to do with sort of that coming down off that. But in a lot of ways, that was sort of, I think that was going to sort of eventually that by the time interest rates were high, that was already sort of the queue wasn't going to keep getting longer. People had a limit to how much of a premium they were willing to pay and how much they were willing to wait. And so all of this has been slowly sort of unwinding over the last year to 18 months. And so we have this weird situation where in 2008 and 9, you have a demand shock that caused, housing starts had been declining since 2006. And then eventually it works its way into prices because the demand shock got too deep. We shouldn't have had that demand shock. And then you get this together with these credit regulations I talked about, you get these deep 25, 30% declines in price that all have to do with sucking demand out of a market that was actually operating normally. Now we actually have the situation that some people imagine we had before 2008. We actually did have a sort of price boom that had to do with inability to meet demand. But this is all like a negotiation between the builders and the customers. So new homes really did have to come down in prices, sort of in a way that existing homes didn't necessarily, because it's sort of there's an interaction between those markets, but the home builders are the ones that know that their supply costs are going to go down eventually, and they're sort of managing themselves. So because of the risk of that and the trouble of it, they were getting excess margins through this period of time, and now we're just seeing a reversal of all that back to normal. So so their costs are going down. We're almost back to, probably within the next 3 to 6 months, we'll be back to that 7-month time frame for building, and they're just retreating back to a normal cost and revenue situation, and so that required relative prices of new homes to decline 10% or more. So the funny thing is, it's probably this, in some ways, the steepest sort of initial decline in prices that you would see looking back historically at what happens with housing prices, but it's not really a cyclically dangerous situation. Their margins are fine. They're probably going to be growing going forward, and so it was really just unwinding this deal they had with the people in the queue. So one of the things that's happening then, because of the interest rate environment, also, builders don't want to just cut their menu price 15%. That looks bad. It's going to maybe create cancellations of previous buyers that are sitting on it. So they're going to come back and renegotiate the price down. So they try to fill that gap with incentives. So they'll keep the stated price, as close to the peak as they can, and then they'll give you free upgrades in the kitchen and down payment assistance. And one of the things they do is rate buy downs, which to me, rate buy downs, it's exactly what you would expect to see in this sort of a yield environment, lenders require a premium because they expect everyone to refinance in 5 years because of the yield curve being inverted.
Right.
So lenders get a real premium for that. Effectively, what the builders are doing by doing a rate price by that, a lot of them are doing permanent, like the full 30-year your loan is at 5.5% instead of 7.5%. They can do that because by giving the customer a 5.5% interest rate, they're effectively saying, "I promise not to refinance. I've already got the refinance rate." So it's effectively a way for the borrower to promise to the lender that there's no prepayment risk on this loan. You don't need that premium, so it actually creates sort of a win-win-win situation where the if you just booked the mortgage based on the present value of the future payments, the builder can actually pocket some gains. The builder, the buyer, and the lender are all sort of sharing some of the gains of getting rid of that prepayment risk. So I think this is what we'll see for a while, is that the market rate price of those houses has to decline because we're coming off this weird period, this unprecedented period of constrained supply. And the builders are going to manage that period with incentives that include rate buy downs. And so, as everything normalizes, you're going to see existing home sales start to recover, and all these incentives sort of minimize over time until we sort of inflate back into, the market price on these new homes inflates back into the menu price, and then we'll just be. So we have this sort of period that will still be normalizing, but my feeling is we're sort of looking at 5 or 10 years of the most boring housing market for the home builders. You could imagine, because they're just going to be growing at the rate that capacity allows, selling the houses at a regular margin, and just slowly closing the gap of, the sort of the leftover effects of this brief period of supply constraints.
Interesting. So definitely not expecting, something like a 20-30% drawdown in house prices at the moment.
No. So, that story I just told was sort of a story from the home builder's point of view. From at the Substack, where I'm looking at things from a macro point of view of like tracking existing home prices. What the tracker would tell you is that, since housing construction has been so low since the Great Recession, that all of these supply-oriented cost increases have been, on double time from, say, 2012 to 2019. Now, I actually think, because I think the Fed has managed the COVID period very well. I'm a big fan of Jerome Powell, and because he managed it so well, we didn't have a housing bust associated with the COVID recession. Construction, which is desperately needed, basically continued apace. A lot of people get confused by, because of this thing where we were just selling houses we couldn't even complete. There's a lot of movement in sales and starts, but if you look at completions have just been a flat line for the last 3 or 4 years. And because of that, partly because of that, and partly because just slowly, finally, we were sort of getting production back up to some sustainable level that comes close to matching demand. I think it's possible that that excess rent inflation will be reduced going forward. And so if the sort of supply component of home prices has been more or less level for the past, say, 4 years, basically what happened is we were semi-recessionary when COVID hit. The Fed had sort of raised interest rates, and they were chasing them back down because they'd gone a little bit too far. It's hard to say whether we would have had a recession without COVID or not. They were sort of running just ahead of the recession's sort of maw from 2018 to 2020. So maybe they would have escaped it, but certainly you can see the reflection of that in housing values. And I would say by the time COVID hit, I would say cyclically housing was probably 10% below neutral value. So housing was there's basically three components I follow the tracker. If you take the median house in the country, in the metropolitan areas, there's a 20% discount because of mortgage constraints, a 60% inflation because of supply over time, and then the cyclical component that sort of moves like this over time, around neutral. That was maybe negative 10% by the time COVID hit, and then over that next 18 months or so, it went back to neutral, and maybe the pendulum swung to 10% above neutral. And that's already basically reversed and then leveled out. So we're basically, I would say the housing market now cyclically is sort of right at neutral and just going sort of, it's the last couple of months, it's sort of ticked up a notch, but I would say right now we're cyclical. There's no cyclical overvaluation in the American market as a whole. There's obviously differences from city to city, but I'd say we're cyclically neutral. And now we've got gunpowder. The builders are still building at the capacity they have, and we're ready to have the building boom that's going to actually solve this housing cost issue. But I don't see any reason to expect any cyclical reversal in home prices that we should either encourage or expect, or it's you've got this weird thing where the home builders had this 15% premium that worked off in the new housing, and now everything else is just nice and boring, and let's just build a lot of houses and prices aren't going to go up or down much, and we could be that way for a couple decades, frankly.
So obviously good news for investors possibly, and I definitely want to get into how maybe someone could profit from the coming 5-10 years. But I wanted to get a little bit more into the Federal Reserve and interest rates, because you have mentioned that the Federal Reserve has done a very good job of managing the situation. A big fan of Jay Powell, you said. Now, I was reading your recent post where you were talking about inflation being transitory, and the idea that the Fed tightening hasn't really had anything to do with that kind of return to normalcy. So, I'd like to, first of all, if you could explain to us what that means, and kind of what your outlook is for rates right now.
I would say it's a good example to me of how thinking of monetary policy through interest rate targets rots your brain, because we're sitting in early 2002 with a run rate of 8 or 9% CPI inflation, and actually the way that headline CPI inflation included this garbage CPI rent shelter component, which, in addition to the problems I discussed before, we know now, it's been broadly discussed that it has a lag the way the survey works, so that the rent inflation the CPI is picking up now is based on these 6-month surveys about 6-month changes in rents that really is picking up rent inflation from a year ago. And so in mid 2022, the headline CPI inflation is 8 or 9%. It's actually 14 or 15% if you take shelter out of it. And the shelter component is not measuring anything useful at the time. It's right. So the shelter component was understated at the time because it's measuring rent from 2020, right, or 2021. So you look. They started raising the target rate in March, and slowly sort of raised it into June, and then started doing the 3/4 point raises after that. And it amazes me that it seems to be the conventional wisdom among macroeconomists that they raised rates, and that finally put an end to the transitory people were wrong, because look, they raised rates and then the inflation went down. And I'm sorry, but there's no model in any macroeconomic textbook that's going to tell you that 1.25% target rate is going to bring down 10 or 50% inflation. Nobody believes that can happen. It's a ridiculous ad hoc explanation for what brought inflation down. There's no way that 1.25% target rates. Now they'll bring in expectations. Well, but the Fed was signaling that they were going to keep raising. At the time, the peak, the expected interest rate was like 3%. And I'm sorry, thinking the Fed's going to have 3% rates in 2 years is not going to bring down double-digit inflation. It's not the way
Mm-hmm.
anyone has ever explained how it works. Inflation came down because inflation was transitory.
Right.
It was transitory for longer than we thought it would be because we had these second and third waves of COVID supply constraints. That was probably most of it. A little bit is the the federal stimulus that was happening in 2021. So all that stuff was bound to reverse. Now, if the thing with transitory inflation is if it's just a short burst, then let's say you've got a burst of a few months of 8% annualized inflation, and then it goes to -3 or 4% for a couple months, and that's all fine and good. That sort of supply related inflation, that stuff's happening all the time within the aggregate. There's always things going up and down, and the Fed's not, isn't supposed to react to every one of those. The Fed is reacting to the broad sort of quantity of money required to keep slow and stable growth. And the problem is we had the supply thing that sort of hit everything all at once, and then it stayed around for a year and a half. And so if that actually had reversed like transitory inflation would, by the time it was done, you'd be looking at a year's worth of 10% deflation, and that would be horrible. So I think the Fed, my position is, yes, the Fed was loose, but their looseness had nothing to do with that inflation. And actually their looseness prevented us from having a deflation. A deflation that would have been problematic. So the Fed when the Fed had the target rate at 1.25% in June of 2022, and that was actually the last month with excess inflation. By July, in non-shelter inflation was less than the 2% target, and it's been that way for the 17 months or however many months since then. Because it was transitory inflation, the Fed had nothing to do with that. Because they didn't try to have anything to do with it, really. They were relatively loose during that period of time, and thank goodness they were. And actually, what ends up causing them to need to raise rates is because they were so successful in not doing away with inflation. They had no business doing anything about. The real expectations of the economy improved greatly. We had this huge, this really just large spike in long-term real interest rates, which the Fed has no control over. That's a sentiment. Right. That's sentiment improving, but it's improving because they were loose. It's improving because they didn't try to fix that inflation. And to the extent you can use interest rates targets to describe monetary policy, of course they were loose. They had 1.25% target on the last month when inflation was at double digits, and then you basically switch to this period where they're chasing the real rate up. The neutral target rate is actually going up, and they're sort of marching up with it.
Right.
So again, it's this problem. If you look at changing interest rates as if that's at all times, the Fed has sort of got a tiger by the tail, and what happens that they're getting whipped right and left, and people say sort of like the Wizard of Oz is another sort of analogy I use from time to time. They're sort of getting whipped left and right, and everyone sort of communicates with this mythology of, oh, look, they whipped the tail to the left, now they whipped it to the right. And most of the time they're chasing the neutral rate up and down, which is a rate we can't really ever divine. We have to guess at. And in the COVID period, it was really whipping up and down. And so in late 2022, the real rate, long-term rates are shooting up by a couple percentage points, and they're just following that up as inflation dives back down to the neutral target level. Then they're slowly becoming tightish because now the target interest rate is above the running inflation rate. In a way, it almost doesn't matter that much. The long-term real rates went up to 3% or something, and the long end of the yield curve is sort of bounced around that 3 to 4% level ever since then. At first, the Fed was below that, and over the course of late 2022, sort of moved up and then went past it. So now the long end of the yield curve is still 3 or 4%, and the target rate's at 5.25%, which I think is way too tight. I think they could be at 3.5% today, and that would be better. But I don't know that it matters that much, because the people are lending as if they're going to be back at 3.5 or 4% within the next year or two. Nobody's building, semiconductor plants at, based on overnight repo rates. They're getting a 10% or a 10-year bond for, so the important activity, even mortgages, right? The important activity is taking place at rates that are based on the expectation that the Fed will pretty quickly get back their target rate back to 3 or 4%. So I think they're way too high now. I don't think it matters that much, but I do think the faster they can get down a percentage point or two, the better. But the economic news keeps coming in pretty, again, I would measure their position based on nominal GDP trends. So I think what happened is we had a nominal GDP collapse with COVID, and we had, then you're catching up to the trend. And so I use a 5% trend. Most of that time where nominal GDP growth was in the, very high, it was in the double digits. It was just catching back up to that trend after COVID. And they really have very nicely just sort of glided back into that 5% path. We're a couple percentage points above what I would consider so effectively the Fed was loose, but it was catch up loose, right? It was getting right. And they've been just sort of glide pathing us, pretty close to that 5% in GDP growth, which is basically, there's a lot of noise in that from quarter to quarter, but the last few quarters, that's basically where we are. We're 5-ish% if you average a few quarters, and I think that's where we'll continue to be. If they tried to stay at 5.25 too long, they'll eventually slow us down too much, and there's really no reason for that. But I think I think probably Powell will get them moving to a lower rate earlier than what the futures markets currently say, because I think it's significant signs of slowing. He's been very proactive in terms of getting ahead of the trends. So sort of like, if COVID hadn't hit, 2020 might have been the first time since World War II. Well, maybe not the first time. They probably avoided a recession in the mid 90s, but it would have been a rare case of the Fed sort of getting ahead of the tiger's tail enough to avoid recession by lowering interest rates fast enough. I don't know if they would have or not, but at least he was giving it a go. He was certainly doing better than they did in 2008. And so I think that'll be his instinct again. And I think the yield curve from 2025 onward now is basically the neutral interest rate for a 5% growth economy that could just go like that indefinitely if we let it. And part of that is that you've got all this pent up demand, this housing market, which is a leading indicator, a very important cyclical indicator. There's just so much dry powder in that market because of the supply problem that it would be very hard to undermine housing in a way that in a typical recession would lead to collapsing starts and all that would be leading in. It'd be very hard to mismanage things badly enough to get housing starts to decline in a way that would be recessionary. So in a way, I think sort of the job in front of them is sort of easier than normal because of all the mistakes that got us to where we are, but also because I think Jay Powell's been pretty, has been pretty proactive about not letting things get in front of him.
Very interesting. So, of course, you say that the Fed did well to be loose in those months, kind of ahead of the disinflation. And then you mentioned that obviously the tightening hasn't had that much effect, right? So really, what in your opinion was leading the tightening then? It's just a matter of the Fed, like you said, kind of chasing that natural rate rather than really, or maybe managing expectations rather than really thinking that tightening, increasing the interest rates was having an effect on inflation. It's just a matter of like chasing that natural rate that you mentioned.
Yeah, exactly. I think I think it's been. I don't know if they'll ever get credit for it. I think it's been a major coup
Mm-hmm.
that they got long-term real interest rates to go up so much in the midst of all this that was happening with the aftermath of COVID. Um, Low long-term real interest rates have been our problem for the last 15 or 20 years. But again, if you treat that as a symptom of loose monetary policy, I think that just leads to confusion. That's the low long-term real interest rates are actually mostly a reflection of past type policy, which then sort of builds up to higher expectations of recession, lower expectations of economic growth in general, because people are basically investing in safe things instead of investing in growth and innovation. And so, really, to me, the long-term real interest rate is more of an effect than a cause. It's basically showing you the sentiment people have about future growth expectations.
Right.
And it's very common for to see complaints about low interest rates, and that supposedly inflates the housing market and all this. I don't buy into all that, but I do think we want interest rates to be higher, but they're going to have to be higher because of sentiment. It has nothing to do with short-term Fed policy. And for in the confusion of the COVID period, for Powell to have allowed that to happen, to basically reverse 20 years of declining long-term real interest rates, was a huge, huge victory. And so, it's great that mortgage rates are back up to where they are. Like, that's the sign of an economy that requires a high, that for fixed income requires a high premium, because people are more interested in investing in at-risk activities and innovative activities. And so it's all for the good. And to me, it's sort of funny. A lot of people have been complaining about low interest rates. The Fed, blaming the Fed for low interest rates for 15 years. Well, we got what everybody wanted, what they were complaining about. Now rates are back where everyone said they wanted them, and they're still not happy. Right? now they're all saying, "Oh, now a recession is going to happen because rates are high." Well, what do you want? Powell he's given you everything, and I hope someday he gets the credit for
it. That's a very good point, and I guess fear sells. People are always looking for the other shoe to drop. But in terms of long-term interest rates, though, what do you think is moving the needle there? How did we manage to pick up those long-term interest rates? Because there's a lot of people talking about the idea that obviously that long-term rates have gone up because of lack of demand, for example, for U.S. Treasuries, which but you're talking more about the idea of growth and inflation expectations. What, in your opinion, is moving those long-term interest rates?
Yeah, I just think it's I think one of the main factors that sort of correlates with real long-term interest rates is sentiment about growth. That real growth tends to be pretty well correlated with real long-term interest rates. And I think there's a causation that goes both ways. That when interest rates are high, it's a sign that investors are preferring at-risk investments over fixed income, and then those at-risk investments create the growth that justifies those high interest rates. I think it's a very complicated dance that interest rates and economic activity have. And I think it's one of those things that we can see those correlations over time, and we can understand that there's a relationship there. It's because it's all based on sort of sentiment and these emergent phenomena. And it's hard to say, oh, here's what you need to do to make growth high and make those long-term interest rates reflect that. And so, to me, the fact that we managed to do it here, we should really want to hold on to that. And with regard to housing specifically, I also just think, I came into this whole period. If I go back and look at something I wrote 10 years ago, I was doing the conventional thing of like before I got into that project I was telling you about in 2015 that led me to where I am now. Um, I was sort of a housing bubble skeptic in a way, but with the conventional, I would say, well, long-term real interest rates are low, and that can explain why home prices are elevated, because you do a discounted cash flow analysis, and you can
Right.
make those low real interest rates tell you that story. Since then, I've discovered that was entirely wrong. When you get into the meat and potatoes of the housing market, it's a local phenomenon. There's all this other stuff that actually explains why the aggregate values are what they are. And so actually over time, as I've developed this model of looking at how supply shortages create all these asymmetrical trends in prices, I've sort of lost the way I look at it now. I try to find an effect of of interest rates on housing home values, and I just can't find it. I would love to use it as a control variable so that people will take it seriously. Uh, and when I try to use mortgage rates or long-term real interest rates or whatever as a control variable in the components of the housing market that I have now developed, I just can't find where there's any interaction at all. Now it's more complicated than that. There are obviously ways that interest rates affect transactions and frictions in the marketplace and stuff, but in terms of just the valuation of homes in the aggregate, I just can't find it. So I don't worry that much about the effect mortgage rates are going to have on new home markets going forward. But I certainly would, if anything, reverse the conventional wisdom. It just is never the case. If you just look historically at how housing markets play out, they don't inflate when interest rates are low and deflate when interest rates are high. It just doesn't happen. It really hasn't. Maybe there's a short period in the late 70s, in the Volcker recession, where you can see that sort of relationship for a brief period of time 45 years ago. But since then, interest rates go down when there's a recession, and home prices don't rise during a recession. The extreme example of this is the post-2008 period, where home values collapsed at the same time that interest rates collapsed. So the idea that interest rates have this negative correlation with home prices is very selective historical reading that I think I just don't think you can justify it as a systematic relationship. It's complicated, but that relationship just isn't there. So I don't worry about mortgage rates and how, if anything, high mortgage rates are going to be associated with an economic boom and a building boom going forward. And the last thing, if you're long on home builders or have exposure to the housing market at all, the last thing you want to see is mortgage rates back at 3%, because I promise that's not going to be associated with good things happening.
Right, very interesting. So the way you see it, barring some kind of exogenous kind of event, or unless Powell keeps us at 6% for the next 5 years, you basically are predicting kind of a stable era of growth, stable inflation. Then you just expect inflation to remain kind of around the Fed target over the next few years as well.
Yeah, I think so. It'll be interesting to see what happens over the next year or two. Because I think probably at this point now the Fed has been tightish, and we might see headline inflation below target for a little bit, and because they managed it so well, and we didn't see a dip in housing completions, and I expect home building activity to continue to grow as capacity grows. We may finally see an end to this decades-long rent inflation excess. And so, really, I mean, if you look back, the post-Great Recession period, we were sort of close to a 2% inflation trend with the aggregate numbers over that decade. But if you take out the shelter component, you're talking maybe a 1% trend. We were actually well below trend for basically that entire period. And to me, I think you should think of it as there's inflation involved with money supply and with productive activities, but rent inflation is really just giving a little extra of our productive activity to the rentier class, to the owners of this endowment, which is land, that they're restricting usage of through urban land use regulation. I think it's actually a misnomer to call that inflation. We're actually we're paying the toll under the bridge a little more each year. It has nothing to do with all the stuff that really is a part of what money supply and productive activity is. That finally may be leveling out. And so actually, I think it may be interesting over the next few years if shelter inflation finally is below target. And a lot of the indicators in the apartment tracking services and stuff, they're showing, pretty level rents. If that can be the case, then, basically for the last 20 years, people have been demanding too tight monetary policy because the rent inflation was making it look looser than it is. Well, maybe now that's not the case anymore. And maybe the Fed will be able to be a little let everything else grow a little more because they're not being misdirected by excess rent inflation. So I think there's a lot of potential for really a sort of boom period and real and nominal growth above the levels we've seen in the actual real economy compared to the last 20 years that I think there's a lot to be hopeful about. And just in general, I think it will be easier for the Fed to manage those targets in a context where it seems as though, all these housing issues are sort of have some tailwinds behind them.
Well, definitely a very positive note for investors. And now, in terms of actually gaining exposure to this kind of boom period, now you've talked a lot about home builders, which I assume you're quite bullish on. Any other assets? First of all, within real estate, so obviously a lot of people are looking at rates. I mean, or maybe if investors should they just go out and get a mortgage and buy a house? And also, any other assets in terms of maybe like stocks or other financial assets that you think are a good investment right now?
I would say that always in terms of owner occupier home ownership, that decision basically always comes down to, are you going to be in the house for longer than 5 years or something? It's very transaction cost generated decision. So I would just say, don't think cyclically about that. If you're going to live somewhere for a while, buy the house and don't worry about it. You probably aren't going to have $500,000 of capital gains when you sell it in 20 years, but in the meantime, you're going to be getting an extra, percent extra return on your investment because you got to be a landlord with the best tenant any landlord has ever had, that always agreed with every decision they made. And which is really the value of home ownership. For in terms of investment, there are potential pluses and minuses if we are going into a period where rent inflation trends are changing. I think you have to be very careful about, you have to really get into the details of if you're looking at buying REITs or multi-unit private equity, that sort of thing. I'm sure that there will be good investments, probably the devil's in the details in all those areas. I would say in terms of potential interest rate plays, to me, it's just watching the Fed, and if they're too sticky, if they refuse to come down fast enough from 5.25, eventually the entire yield curve's going to drop, and that would be where the speculative play would be, as if you could see that was happening. There tends to be a momentum in those plays. The Fed rates tend to go up faster than expectations for a while, and when they are, they keep doing it for a while, and then they reverse, and so there tends to be some, I think there's potential if you've got some foresight as to, oh, they're going to be behind the eight ball on this. You could go long on some interest rate futures, but again, that's a call you've got to make in real time. I don't think we're certainly not there now. I do think the home builders in general are the sort of no-brainer position here, and effectively. In a way, I think you could say it's a situation where you're actually looking for low quality because it's the cyclical fear. I think the cyclical fears are overblown, and so the most leveraged, the home builders that were sort of the closest to failure before the new housing boom finally sort of pulled them up above the surface. Are the ones that still sort of lack the reputational value. They still haven't been fully priced in to a boom valuation. In general, I like to. It's a very broad benchmark, but I like to just as sort of a broad brush, just look for like a enterprise value. At some point during the cycle, the home builders will tend to have enterprise value higher than their revenue level, and which is sort of a sloppy metric. But I think I think you could talk your way into a justification for it on the specifics. But I think that's a nice broad brush sort of way to look at which home builders have the most potential. And I think all the home builders have growth potential because we're at an activity level now that we definitely could go 20 or 30 or 50% higher in terms of annual production and still have we've got years of production of 1.5 million, 2 million units a year to make up for all the supply that we could easily utilize. If builders built 5 million units today, and then not a single one of them sold, and they were all just set vacant, we would actually be closer to normal than we are today, because normally there's 5 million more vacant units than we have today. So we need to build 5 million empty units. Forget about household formation and all the other things that need to catch up, or the high rents of the expensive cities and all that. We need 5 million empty units just to be normal. And so so anyway, even the sort of the D.R. Hortons and the Lennars and the Pulte's, the sort of leading home builders, they're probably, if you look at today's revenues, they might be pretty close to that enterprise value equal to revenue sort of. I would consider that sort of, they can get above that, but that's sort of the bottom of the range you'd expect them to get to eventually over a cycle. But they're all probably looking at 50% growth over the next decade as we work our way into this building boom. But some of the more leveraged builders, A, because the leverage, and B, just because they're going to continue to grow their revenue base, have a lot more potential for stock appreciation. Hovnanian is probably by far the most potential for. They're trading it. I haven't looked at today, but something around $90 a share, and I think they're easily could get $400, $500, $600 by the time the boom plays out. Beezer's another one that is still somewhat undervalued, partly because of the leverage. MI Homes, which I think trades as MHO, is another one that I think probably has more upside than the typical builder. But really, to me, what you're looking for is builders that are still that are actually still trying to regrow back into their operational and financial leverage because they're still affected by the 2008 collapse. And so in a way, when you've got the tailwinds, go for the low quality that still has room for evaluation recovery. I mean, Hovnanian, like I said, they're trading at 90. They were at like $6 to $8 a share back in the summer of 2019 because they were going. There was a bankruptcy risk really at the time. They got a delisting notice back then for valuation being too low for the stock market. And so with them, I think all these things are sort of adding up. They can pay off debt. They're going to regrow into their operational footprint. They're going to pay off high interest rate debt, and you're getting this transition from valuing them on a going concern risk basis to valuing them as just another home builder. And all these things just multiply on each other when you get down into those builders.
Yeah, that actually makes a lot of sense. It's a very good way of thinking about it. So there you have it. I think some very keen insights there. I think the listeners will definitely appreciate. Where can we find people on the internet to find you, and what can they expect to find?
Oh, where can they find me? Is that what you said?
Yes.
At Twitter, I'm K.A. Erdmann with two N's. KAERDMANN is my Twitter handle. That's where I tend to do my my hot takes and interact and see what find what people are talking about. And then again, the Substack is the Erdmann Housing Tracker. KevinErdmann.substack.com is where I do all my writing these days. Occasionally, I've got a paper I'm trying to finish. I am still an affiliated scholar with Mercatus, and I've got several papers. You can go to mercatus.org and see some of the papers I've put out in the last couple of years. And there should be another one coming out over the next few months if I can get off my butt and get the edits done on it. That again, just all sort of build this model of how to think about home housing valuations and how supply is the core element creating all this valuation inflation.
Absolutely, definitely some very interesting ideas there on the Substack. And just want to say, Kevin, really appreciate you taking the time to do this. Really enjoyed the conversation, and hope we can do this again sometime.
Yeah, absolutely. Anytime. It's been a pleasure.
Awesome. Thanks for coming on. Bye-bye, everyone.